Welcome to All Things Real Estate. I'm Terry LeJoy, your host, 20-year real estate veteran with Keller Williams Coastal and Lakes and Mountains Realty.
And I am Sean Sandville, owner-founder of Oak Hill Solutions.
Hi everyone, welcome back to All Things Real Estate. I'm your host, Terry LeJoy with Keller Williams Coastal and Lakes and Mountains Realty. My co-host, Sean Sandville from Oak Hill Acquisitions. And today we're here with Paul Goba from New American Funding, and we're going to be talking about DSCR loans. So, Paul, just tell us a little bit about who you are first, and then we're going to get into this very fun loan program.
Yeah, great. Well, thanks, Terry. Well, I'm Paul Goba. I'm from Hooksett, New Hampshire. I've been in the mortgage business now 25 years. It's hard to believe, a quarter century of lending money and helping people buy houses, refinance. So it's been a long time. I have 3 little kids at home and my lovely wife, Christina.
Who's amazing.
She's amazing. She's British. So it's like, you ever watch that show, The Nanny?
Yes.
Yeah, it's kind of like living with the nanny at all times. It sounds great, but 13 years in, maybe not so much. I'm just kidding. No, she's great. So
she is.
Yeah, so that's a little bit about me. I work for New American Funding, and I love helping people buy houses, refinance, purchase investment properties, etc.
Awesome. So you want to tell us a little bit about DSCR and what that means for people that have probably never heard of it before?
Yeah, a lot of people say, what the heck is a DSCR loan, right?
Yep.
So, it stands for debt service coverage ratio. And so what that means is that it's for investment properties only. And we basically take a look at what the property has for gross revenues compared to what the costs of the monthly costs are, the principal, interest, taxes, and insurance. And basically we figure out a ratio on that. And so based on that, we get a ratio. So if let's say the total revenue is $2,500 per month on the investment property, and the total mortgage payment is $2,000 a month, well, that would be divide that $2,000 into the $2,500, so you get a 1.25% debt service coverage ratio, and that normally would meet the guidelines to do that type of a loan.
Okay, awesome. And so, who are these loans good for? I know you said they're for investments only. Is it for, would you say, a newer investor or maybe somebody more seasoned? Like, what's the application?
Well, we can do the debt service coverage ratio for brand new investors. You have to start somewhere, right? So we can do that. We can do it for new investors. Seasoned investors love this program because, I don't know, have you ever gone through the mortgage process before?
Oh, yeah.
Yeah, and what do you have to provide? You have to provide a lot of
Everything.
right? Tons of documentation, right? I call it the financial colonoscopy.
Yeah.
They'll know everything about you from the inside out. That's mortgage people. So if you don't want to go through the financial colonoscopy, a debt service coverage ratio is a great option because we don't need to see your income, your W-2, your pay stubs. I don't even care, honestly, if you have a job, as long as you have good credit and the property pays for itself. And the appraisal comes in good, it's not falling down. It's not a shack, right?
Yep.
And I know in New Hampshire right now, you can buy a cardboard box for it costs you $300,000 on a piece of land.
Yeah.
We actually want to see a real piece of real estate. But yeah, it's just based on that debt service coverage ratio and how strong your credit is, and depending on if you're a first-time investor or a seasoned investor, might determine how much we want for a down payment, what your rate's going to be, etc.
Okay. So it sounds like there's a couple different down payment options depending on how seasoned you are. Can you talk about that a little bit?
Right. So basically it comes down to this. The higher your credit score is, the higher your credit score is, and if you're a seasoned investor, the less money you have to put down. Now there's kind of a formula to it. So the less money you put down, the higher your rate's probably going to be, though, because you have less skin in the game. So being more of a loan for investors, the more money and more skin you put in the game, the better your rate's going to be. And the better that debt service coverage ratio is going to be. So the more money you put down, obviously the lower the mortgage payment, your DSCR ratio is going to be higher. Okay.
Now, are these loans capped at all? Like, I've heard before, and I don't know if it's true or not, that if you're taking loans under your personal name, you can only do so many before you get capped. Is that the same with DSCR?
Right. Great question. So you have great questions today.
Oh, thanks.
Thank you so much. So with a traditional conventional mortgage through Fannie Mae or Freddie Mac, where most loans are sold to, they typically have a 10 property limit. And then after that, you have to, either your loan to values go way down, or they may not even allow you to borrow and do another Fannie Mae or Freddie Mac loan. So you have to just check with your lender and see what their guidelines are. With the debt service coverage ratio loan, you can have as many as you want because each of them are standing on their own. as far as their income to what their costs are. So as long as you can have as many as you want, as long as you keep your credit good,
Yep.
as long as you still have the down payment for the next one, and make your payments on time, you can go out and get as many as you want. You can also hold it in an LLC.
Yeah,
So,
that's the big one. At least
the
for
big
somebody like myself, right?
So if you want to add that extra layer of protection, you could have each property could be in its own LLC.
Not tied together, less liability.
Yes,
all the good stuff.
Yeah, exactly.
Yeah. So, I mean, for the DSCR loans, why have most investors, do you think, haven't heard of them? Because when I talk about DSCR to, I would say, the everyday investor that maybe goes to like your typical RIA or something like that, they don't really know about them. Is that because people just don't talk about them? They're not marketed, or why do you think that is?
Well, that's a good question. I think a lot of it has to do with the lender. Maybe the lenders are going to A or B. It is a relatively new program. I mean, it's only been around probably for, what would you say, 5 years, 6 years? Maybe?
Yeah.
I mean, back between 2000 and 2009, there was all sorts of exotic programs.
Yep.
We used to have the Nina Nee. We used to call it no income, no asset, no employment. You could buy an investment property. They didn't care what the rent was.
Yeah.
If you could fog a mirror, you could get a loan. But that's changed a little bit. So
Yeah.
the DSCR is kind of the new world iteration of that, where it's more based on the property than it is on the individual. But you still have to have good credit. But
Yeah.
so maybe loan officers don't know as much about it. And
Yeah.
that's why they're not telling their investors about it.
Yeah.
And
So
they're not doing those loans, even though it would make everybody's life a lot easier.
yeah.
So I'm going to jump in with a question, because you're talking about credit,
Yeah.
and you say you have to have good credit. When you say you have to have good credit, and I'm going to use you, Sean, as an example, because you're an investor and you have an LLC. Are you talking about his business credit or his personal credit?
No.
Because there are two different credit
Right.
scores.
So we'll lend, you can hold title to property in your LLC, but you're going to basically personally guarantee through your credit to repay that note.
Okay.
So we're still going to pull the client's individual credit report to make sure they're a good risk for us,
Okay.
right? And they're going to hold the title in that LLC that they own the LLC still. So there's still a paper trail, right, of that person to the LLC.
So if the LLC has been in existence for a period of time, and the individual actually knows that they have a credit score for the business, for the LLC, can they put it in the name of the LLC so that they're completely removed from it?
The financing itself.
Yes.
I don't personally have those programs right now at New American Funding. I think that would fall more under a commercial loan scenario. So if
Okay.
you could find a commercial lender that would do a DSCR loan, I believe you could do it that way.
Interesting.
Have you found anybody that does it that way, Sean?
I haven't personally yet.
Okay.
No.
I'm sure there's somebody out there that does it.
Probably.
Probably. There's so many new programs coming out on a daily basis. But that's a great thing to ask. People can ask their lender and see if they have a program they can do both the financing and the credit report on the LLC,
Right.
on their tax identification number, and hold the property in that same LLC.
Because that
That'd
also
be- yeah.
requires that you know that you have a business credit score,
Right.
and that it's sufficient
Right.
to handle a loan like that.
Yeah, that'd be a great thing to have. We're gonna have to look into it, Terry.
Yeah. Probably more for a seasoned investor that has some business credit, or just somebody that's had their LLC for a little while.
Right.
Because it does take a little while to build that up.
It does. And it's a specific way of doing it too.
Yeah.
So,
Right.
and
When you first start, sometimes you pay higher rates on all of your financing to try to build that tax identification number and give it its own credit score.
Yeah.
correct.
Absolutely. So would you guys do anything? So me coming from maybe a bit more of the creative side, the DSCR loans that you currently write now, you mentioned a down payment. Can you bring in a private lender to cover your down payment?
You
To
mean
put them in, putting them in second position,
putting them in
essentially.
second position. Most of our lenders have a combined loan to value ratio limitation. So I would say no with the investors that we use right now.
Yep.
Again, somebody might allow that.
Yeah.
If they want a commercial loan because they don't really, commercial loans a lot of times they don't really care where the money comes from.
Yeah.
We're still qualifying the person on their credit, their assets, and you can hold the property in the LLC, but we're still qualifying the individual. So
Okay.
I don't think we'd be able to go too high on the combined loan to value.
Gotcha.
I don't have the exact ratios in my pocket.
Fair enough.
I could look up my guides if you'd like me to.
Yeah. So in terms of like the process for DSCR, let's say somebody makes an offer on a property and they get it accepted and they reach out to you to go DSCR, what's their typical turnaround time? Like, what should they expect through that process? Because you did mention it's not like your traditional mortgage.
Well, we'd like to have a minimum of 30 days
Okay.
to make the turn. A lot of it just comes down to the appraisal. So however fast we can get those documents out to the client to sign, as soon as those documents, those initial disclosures are signed, then we can order the appraisal. So figure a few days for the documents to be put together, signed. So day 3, let's say we order the appraisal. Appraisers are about a week to 2 weeks out right now, which is pretty fast. January is not the busiest time in New England. Now, if you ask me that same question in June or May, we might want 45 days to close that loan because appraisers are backed up. There's a lot more people buying homes. So I'd say we want at least 30 days. Realistically, 45 is nicer to have.
Yeah. Okay. And this doesn't sound like something that you can be pre-approved for because it's written based on the asset that you're purchasing.
You're kind of pre-qualified to buy something because we can see what your assets are or what the client's assets are to buy the property. We know what their credit score is, so we know based on their asset position and their credit score about what they can afford from a down payment perspective and what the rate's going to be based on that credit score. But you're right, we don't know what the property's going to be, right?
Yeah.
They might be an investor that's looking for a 1 unit, a 5 unit,
Yeah.
an 8 unit, 4 unit, or whatever makes sense. So it is hard. It is going to be property specific what we're going to be able to approve that person for.
Okay.
Now, is that easier to get if it's more units? Because typically more units means more income and more steady income.
Right.
Because if you've got 1 or 2 units that are vacant, there are plenty of other units still paying that mortgage down.
Right, exactly. Yeah,
So is that a preference?
The more unit, that'd be the rule of thumb. The more units we have, the more revenue we have, so the better that debt service coverage ratio is going to look. I don't know if you looked around, but right now multifamilies are super expensive in New Hampshire. So sometimes even if you have 4 units, it's still barely covering or not even covering the total mortgage payment. So luckily we have a savvy, realtor and a savvy investor that can help guide people to find the right properties. But
And ideally, if we can find properties off market, you can get a better deal.
right, if you can find it off market, absolutely. So knowing the right people and working with the right team makes all the difference.
That it does,
It does.
on all sides.
I mean, how many off market transactions have you found for people this year?
I think together we've
Or
done like
25, I guess.
13.
This year it's only been 7-8 days,
Right.
but I mean, I think last year.
But I think 2025 collected together, we did like 13.
I think 13 total, and then I'd have to go back and look at all the ones that we did, but it was a fair amount that we found off market. I don't think I did a single on market deal this year.
No, and I brought, I think, 2 or 3 to you
Yeah.
that were off markets. Because we go both directions.
Yeah.
We work back and forth depending on who we run into and what their situation is. We pull each other in on a regular basis. So we've probably, I would say 20 plus
Yeah.
this year, which is
That's great.
a fair number.
Right.
I think most people don't even, they hear that you can get properties off market, but they don't know where to find them or who to contact or anything like that. And so our ability to go back and forth means we're also tapping into both of our markets and our client bases to see who's a good fit for it. And we keep it off market, or sometimes we put it on the market and
If it makes the most sense.
if it makes the most sense and we can get the maximum value for a homeowner that way, then that's what we do. Really depends on the situation.
So I think my big question would be, you're using the income from the property to qualify the property for the loan.
Right.
What sort of pay stubs, profit loss, like what are you looking for to make sure that that rent's actually there? Because a lot of these, like especially we're talking about off market, we see a lot of landlords that are just mom and pop and they go pick up the checks in person. They're not necessarily tracking. So like,
Yeah, there's very few records.
yeah, there's not a lot of records. So if I go out and I make an offer on a property, get it accepted, like what are you guys specifically looking for to be able to show that the income is there? Because sometimes there's not even leases in place at that point. They're just month to month if it's been a long-term owner.
Right. So there's a couple of ways we do it. So if the property, let's start with the properties. If the property is vacant, we're going to rely on the appraiser to give us. We'll do a comparative rent schedule, and the appraiser will look at like properties around the area and what those are generating for rental income. And we're going to use basically an average of that rental income that's coming in of those other properties to qualify the loan. So, you have a 3-family that somebody's selling. It was recently renovated. It's all vacant. Let's say it's in Nashua. The price is going to go out. Take a look at other 3 families in the area that are all brand new, relatively new.
Yep.
Figure out, okay, well, each of these units probably generates $2,500 a month for a 2-bedroom.
Yep.
Times 3, $7,500 a month. That's what we're going to use.
Okay.
If it's currently rented, the books are bad. We're not really sure.
Yeah.
We don't. They might have a rent roll that we can get. We ever heard of the rentometer?
Yep.
No.
Yeah, there's a website called Rentometer, and you could plug in, where the property is, how many bedrooms, baths, and whatnot, and that's going to give us kind of a good indicator of how much those rents are going to be.
Now,
There's another way we can do it.
what do you look at because a lot of these mom and pops, they've had tenants in there, in some cases for 15 or 20 years. And they're paying less than 50% of market value.
Right.
Because, they pay the rent every day, every month, and the homeowner just wants to keep them in there to keep them happy and keep the place rented. If you're running into a situation like that where there are current tenants, but they are way below market rate, are you using the current rent rolls, or are you using a blend of that and what market rate would be? How does that work?
If the loan still qualifies with the current rent rolls, we'll just go that way. It's easier for everybody. But if it's not qualifying, we usually do an explanation letter like, hey, these market rents are way under. Mr. and Mrs. Seller were older folks, and they just want to take care of their tenants, and they had enough money they didn't put it to market rent, and so then we'll hopefully use that letter with a combination of what the appraiser says that the market rates should be.
Okay.
And find a happy medium ground.
Right.
Middle ground.
Middle ground.
Yeah, happy middle ground. So we'll find that. We'll use that.
And at that point, would the investor also be kind of on the hook to have the financial backing to cover the difference? Like, are you looking at their income at that point to make sure that?
We don't look at their income, but we will look at from an asset position. We do normally on a DSCR loan, we like to see 6 months of reserves for the monthly payments in their account after the closing.
Okay.
And if they're a first-time investor, sometimes we want 12 months. So just to make sure in case there's a shortfall, they can make up for it, at least cover it until they can get the property stabilized and get those rents back up to market rents.
Right. Cool.
Yeah.
That makes sense. So, I mean, in terms of I guess it falls into renovating the properties and stuff like that. If the properties are, maybe you've already answered it, but if the property's not quite at market rent, but the investor does plan to go in there, like get the tenants out, renovate the units, and then get it up to market rent, is that something you guys will still look at? Will it still can you use future coverage, like a future rent roll?
Right. Well,
projected rents, I guess?
Go back to the appraiser to try to get the comparative market analysis.
Okay.
B, if we need another out there, we also do have no ratio DSCR loans where we don't actually even figure out a ratio.
All right, you got to talk to me about that.
Yes.
That's something I've never heard of before.
It's a relatively new product, but if somebody has really good credit, good money down, now you're going to pay higher rate for it. But if we have a weird situation like this where we know as an experienced investor that property is going to make a lot of money, but I just don't have any way to prove it.
Yeah.
Right, or it's really in shambles right now.
Yeah.
I'm going to go throw $100,000 more into it, or $200,000, and make it nice. We can do a no ratio DSCR loan, purchase a property that way. So we're not going to even give a proposed income. Right, we're just going to qualify based on the client's credit and their asset position and their experience as an investor.
Okay.
And that's it. So you can go. That's a good out for us to do it that way, so we don't have to worry about it.
So you'd mentioned really good credit, good down payment.
Yeah.
What is that? Quantify that
really
for me.
good credit in the DSCR world would be at least a 700 credit score.
Okay.
We'd love to have a 740 or better.
Yeah,
right?
of course.
That's usually better, but it's at least a 700, and then 25 to 30% down.
Okay.
Which is not unreasonable.
It's not unreasable.
A 700 credit score is not what I would call really good credit.
Yeah, I would say the average is about
kinda
684. So it's a
and
little
then
average.
most investors are looking to put 20 to 30% down anyways, and they kind of plan on that.
Right.
So you're kind of right in that ballpark of where I think a lot of seasoned investors live anyways.
Right. And if you were looking to do a Fannie Mae or Freddie Mac loan on an investment property and you're buying a single family, you need to have at least 15% down anyhow.
Right.
On a multi, you're going to need to have 20 to 25% down anyway. So it's not really much more than you would put down anyhow. And you don't have to. So it's pretty amazing that we can do that kind of a loan with only an extra 5 or 10% down, let's say.
Yeah.
And the rate's not that much higher, and you don't have to show W-2, pay stub, tax returns. You don't need the financial colonoscopy.
Yeah.
You don't wake up feeling groggy. I mean, you're ready to go.
Yeah.
So.
And those those interest rates that you had mentioned, are they typically right in line with what the market's doing? Are they a bit above because it is more of a riskier loan, I guess?
It's
High risk.
going to be a bit above.
Okay.
Yeah. So be prepared. Most investors are going to have to pay a couple points to get the loan.
Yep.
Sometimes it could be financed in, which is odd, right?
Yeah.
Fannie Mae, Freddie Mac loans don't do that, but some of our lenders allow you to finance the
points up front.
in up front, which is nice. Keeps more money in your pocket as an investor. So yeah.
What are, for people that don't know, what are points?
Okay, a point is defined as 1% of the loan amount at closing, which is used to buy your rate down early,
Gotcha.
to pay the mortgage banker or broker and to buy the rate down.
So when you're paying a point and you're buying that rate down, is it, because I've heard of some of the rates that step, so it goes down lower now, but 2 years from now it goes up.
So that's what we call a temporary buy down.
Okay, and this is more of a permanent, so it's for the life of the
For
loan.
the life of the loan, right.
Okay.
So that's the conversation we have with the investor client. So depending on what our plans are. So if we go back to your scenario, Sean, person's going to buy it. They want to do the no ratio DSCR, but they're going to put a whole bunch of money into it. It's going to be a really nice property when they're done. We may want to go with a lower points option, go with a higher rate, because we know that we're going to hopefully fix this property up, refinance it in 6 months or a year, pay the higher note off, get a lower rate. Maybe they want to pay points at that time once they have the property stabilized and ready to go.
Yep. Okay.
And you mentioned refinancing. Is there a time frame before the loan is eligible to be refinanced, or?
In most cases, we need to wait 6 months.
Okay.
Okay.
6 months. Well, technically on the note, you don't normally have to. Well, let me rewind. DSCR loans sometimes have a prepayment penalty depending on what state you're in. Some states allow it, some don't.
Okay.
If you do take a prepayment penalty, typically you get a better rate
Yep.
because the lender is now guaranteed to receive that money for 1, 2, 3 years with that prepayment penalty. So there can be that because it's an investment property. So that's A. And then, but it's normally 6 months. If you pay it off before 6 months, it's called an early payoff.
Okay.
And your mortgage professional there will be charged back any earnings they would have made. So even if it's not on the note, do your mortgage loan officer a favor and wait 6 months, make 6 payments first before you pay off the note. Some of them are 12 months, so you just have to ask them.
Yeah. And for like your good old traditional like kind of BRRRR style properties where maybe you're purchasing the property with hard money because you need it to close really quick, you do get it fixed up. Is there any sort of seasoning period that you guys want to see in terms of like renters being in there and the property performing the way it should before you go DSCR?
Not necessarily.
Okay.
Some lenders have seasoning requirements on how long you've had that note with the hard money lender before they'll allow you to do, let's say, a cash out refinance, though they may not have any seasoning on a rate and term refinance, and people may not know what that means. But a rate and term would be just refinancing the existing note and getting up to $2,000 in cash out. Whereas a cash out refinance, well, let's say you bought that property we were talking about earlier. You bought a 3-family, you fixed it up, and now it's worth hundreds of thousands more. And if you want to take the money back out that you put into it, you might. Some lenders do have seasoning. You might have to wait 6 months or 12 months to go and get that money back out.
Okay.
Others don't have any seasoning. Usually the riskier it is, the higher you pay for a rate. So that's how it goes.
Right. And I'm going to shoot a question back to you because you just used an acronym that not everybody may know. Explain what a BRRRR is.
I mess this up all the time. Buy, renovate, refinance, buy, renovate, rent, refinance, repeat.
Okay. So buy, renovate, refinance, and repeat.
Yeah, so in a perfect world, it's basically you buy a property far under market value, you force appreciation by refinancing it, so you just increase the price that it's going to be worth at the end. You rent it out, so you put renters in there so it becomes a cash flowing asset. You do what Paul talked about, which is a cash out refinance. So you pull all of your original money out in a perfect scenario, right? Sometimes you got to leave money in there, but in the ideal scenario, you refinance, so you're clearing out your hard money lender, and then you're pulling capital out of the deal. And then in the perfect world, you go repeat that, you go find another property, because when you take money out of a property, it's tax-free because it's debt. It's not actual income. So that's been a strategy that's been around for probably longer than I've been alive, honestly.
Yeah, it's been around a long time.
But it's a lot tougher nowadays, because you had mentioned like cardboard box on a piece of land in New Hampshire now is like 300 grand. So the numbers have to line up. So I don't see them as often anymore. Like back in 2021, like, yeah, those are great because you were refinancing into a super cheap interest rate, and just the prices were going up and up and up. So it made it work.
Right.
Well, yeah. If we'd done that strategy 2012, 13, 15, 16, 17, I mean, you couldn't go wrong, right?
Yeah, you'd have a massive portfolio.
You couldn't go wrong. You could buy, you could totally overpay for a property. Just wait a year or two, and you'd be fine.
Yeah, absolutely.
That is changing.
The market is still going. The market's pretty. How is the market right now?
We've stabilized a little bit. We were coming down. About 60% of the country right now is in a buyer's market. New England and the East Coast, most of the East Coast is still in a pretty solid seller's market. It's not we're not as deep into it as we were, and average list prices come down a little bit, but it is changing.
Yeah,
and I think it's going to continue to change. So that's all good. Well, we are about out of time. Paul, thank you so much for explaining what a DSCR loan is and clarifying how they work. And we're going to have you back again to talk about other loan programs. So thanks for being here. Sean, thank you for running that conversation.
Yeah, absolutely.
And, so we'll see everybody back here next week.